Well, it's always a bit difficult coming in so late in the conference. Most of the previous speakers have stolen my best lines, taken all the interesting topics. So I'll be sort of wading through quite a bit of previous material and trying to extract some reason out of that in terms of with the peak oil overview, but I also want to draw comparisons between the factors impacting on oil and minerals development and production and the factors impacting on food production and then to assess the concept of, in fact, peak food as we go forward. So here's just to sort of amplify a bit on what Bruce has so well covered. We see that the finding and development costs for oil have risen from around the sort of $5 to $8 a barrel and now currently around $20 a barrel. So if you add in the operating costs and the financial costs for producing oil, you basically need $50 a barrel US now to break even on any new oil that's being produced. So you know that puts a sort of a line underneath where the oil price can go on the downside. The stats from the IEA, just again to reiterate the sort of information that Bruce was bringing to us, show that over the last 2 or 3 years, the production of oil has been on a sort of plateau, with the OPEC really struggling to make any advances after a big jump in the early part of this decade, and the non-OPEC producers have also struggled, and we expect that there will be some increase in OPEC production, certainly from Saudi Arabia in the next 2 years, and there are some large fields in non-OPEC areas that are going to come on, and potentially oil production could lift from around the 86 million barrels a day currently to 88 million barrels a day on a good day. But you know, there haven't been too many good days in the oil industry over the last couple of years. You know, there are floods, there are typhoons, there are wars, there are problems in Nigeria, problems in Venezuela, Iraq, and so it goes on. Oh, that's an interesting slide. One of my subscribers has put together a slide which shows that in fact the oil production is peaking as we speak. Tony Erickson he's studied this very carefully, and I tend to agree that in fact I think oil production is peaking now. And he also then plots the expected price, because we've learnt that and certainly from our talk at the dinner last night, that the inelasticity of demand for oil, with the price going up, the demand remains fairly firm. We haven't seen very much in the way of oil conservation, as the oil price has sort of quadrupled over the last 4 or 5 years. So what we're seeing is that the mechanism for making demand equals supply, which is restricted, is going to be price. And so $110 a barrel now may seem very, very cheap in even 3 years' time. However, in the short term, it has to be said that there is a bit of a glut of oil in the market at the moment. The price is high because of other financial factors, hedge funds, traders in the market, and pushing up that price. And I think that as we move into the Northern Hemisphere's spring, as the first crocuses and daffodils appear outside the Chicago Mercantile Exchange, the traders will notice that it's a bit warmer, and I think we'll see the oil price back at $85 a barrel sometime in May, but that's really only a short-term impact. So what we're seeing there is that in fact peak oil is a current thing. Technology is playing a part, but I question, like Bruce, whether the impact of new and efficient engines or the impact of renewables or biofuels can limit the growth and bridge the gap in the time that's required. We have the technologies, there are technologies about, but they can't come in 10 or 15 years to make that impact. So the response to peak oil really what we've seen recently is that China is aggressively bidding for raw materials of all sorts in Africa and South America, and yesterday they made a cash bid, an aggressive bid to buy, Sino-Steel made a bid to buy Midwest Iron, one of the big developing iron ore producers in Western Australia. So these are government funds, these are monies coming from sovereign equity, and they're going to be looking to expand their influence all over the world. Africa, South America, Australia is also playing a part. They play by their own rules. The reports of indentured labour in Angola from China to do work there. The market for oil is likely to break down, in my opinion, and replaced by what? Rationing, quotas, tendering, mates rates. I don't know, but it's going to happen. This really shows what's happened over the last couple of decades. During the 1990s, we had this infamous age of waste and cheap oil, and it's really typical at the peak of oil production, when oil is most abundant, that it would be the cheapest. And in those days, the average worker in Europe could buy 2,000 barrels of oil with his salary. These days, it would be less than 400 barrels of oil with the average salary in Europe. So in some ways, it's a good thing that the oil price is so high, because it's going to mean that we have to think about how we use it. Like, as it was said in that documentary, you know, in 20 or 30 years' time, people will say, like, you burnt that oil? You know, why did you do that? So we're moving into a world of scarce oil. It's arrived. There's been aggressive positioning by economies ahead of the crunch time. The oil wars have arrived. The control of oil supply is largely in government hands already, because 70% of the world's oil production is produced by national oil companies, the Saudi Aramcos, the Angolan National Oil Company, the Indonesian National Oil Companies, Venezuelan National Oil Companies, and so it goes on. Major producing fields, as Bruce said, and provinces, in fact, are in decline. Production is restricted by access to skills currently and capital. Wars and social unrest, as well as the normal weather events, are also restricting supply. So just to make an analogy here, this is the production of gold over the last sort of 250 years. And it's interesting to note that you can see there in the early 18th century, early 19th century, 1850s or so, we had a rise in the oil price, or in the production of oil, of gold, because of the discoveries in California, followed by the discoveries in New South Wales. Then that petered out through the 70s and 80s, 70s, 1880s. There was a recession, and then in 1890s there was further discoveries in Western Australia, followed by the huge discoveries in the Witwatersrand, which led up to the peak of production in World War I. Following World War I, we had the fixing of the gold price for many years, and so gold production didn't rise very much, although there was still continued expansion of the reserves and production in the Witwatersrand, where mostly they were mining sort of 10 grams a tonne, and in today's dollars that's like $350 a tonne for that ore, which is pretty valuable when it was costing them perhaps $50 or $60 a tonne to get it out of the ground. So then, interrupted by the Second World War, and after the Second World War, we had the impact of new technologies coming through, mining, mechanisation, leading up to a peak in 1972. We had a recession in sort of 83. Bob Hawke came in, and the production of gold continued to rise, largely on the back of new chemical metallurgical techniques, carbon in pulp technology, which brought the average grade of oil, of gold, produced gold ore down to maybe 1 to 3 grams a tonne. So the reason I do this is because this line is actually almost shows you the history of the planet in the last 200 years, and gold production has has responded to various other factors, technological factors, supply-demand factors, wars and so forth. But what we see here is in fact that the gold production peaked in 2001